Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's just after noon on Tuesday, November 27th. We're joined now by Adam Collins of Movement Capital. Adam typically joins us on Mondays to go over the latest CoT report and market seasonality, but due to the Thanksgiving holiday, everything was delayed today, so we're talking to him Tuesday. Adam has great information. He provides, he has a few different websites. He has Movement Capital, freecotdata.com, simplestockmodels.com, and commodityseasonality.com all have a lot of really interesting data facts on the market. And so Adam joins us talking about all those different tidbits. I'm interested to hear about the commodity market specifically today, but we'll let Adam get to it. How's it going, Adam?
It is going pretty good. Happy to be here. And right off the bat, none of this is investment advice, so don't treat it as such. And for new listeners, the main thing I talk about is CoT data. CoT data breaks down how traders are positioned in the futures markets. And like, here's an example CoT report. So you got different categories like producers and users, money managers. You got long, shorts. If you take the difference between the two, it's the net positioning. But it's important to not just know the current net positioning, but to know if it's extreme or not relative to the past. And the way I do that is I make a 5-year percentile. All it is it's the number that scales between 100% and 0%. So if it's at 0% for speculators, like right here, what that means is that like at this point in time, traders were more net short than they had ever been over the past 5 years. Vice versa with the producers and users. And so the way this website is set up is the most important page, the one I check the most, is the dashboard. So this takes the different categories like, speculators in commodity futures or speculators in financial futures, and it shows you that 5-year percentile for all the different contracts. So we can quickly see where people are leaning long and where people are leaning short. So we can see that right now, traders in commodity futures, to no surprise, are extremely long natural gas, and a little less so palladium and oats. And then on the short side, honestly, not a lot other than orange juice, which is, I know it's like very few people trade it, but I think it is still worth talking about because traders haven't been this short that contract in 5 years. And orange juice is it's actually been going up quite a bit recently. So other than that, it's traders they're not super optimistic on silver gold, nothing new there. And then there's not really any new contracts on the right-hand side, but it's a little unique because palladium it's one of the precious metals, like, platinum, gold, silver. But that's where sentiment's completely opposite. Is traders are quite optimistic on palladium right now. So this is commodities, and then we can dive into financial futures. Okay, so the most crowded long positioning is in the dollar index contract. Now, I will say that the dollar index futures are quite illiquid. And so to properly assess like currency positioning, I think a better way to do it is to look at the major contracts, not so much the dollar index. We've got, let's see, Aussie dollar here, Kiwi dollar here, Swiss franc here, and then yen here. So regardless, and then in fact, pound and Canadian dollar here. So you can see that this does corroborate in that for like foreign currencies, speculators are leaning very short in those contracts, the most in the yen. That's for short position. A little less so in the Swiss franc and the Kiwi dollar. And I know I talked in previous conversations about how, positioning was so short in Kiwi dollar, and it still is. It's just no longer extreme. And so, Kiwi dollar's popped up a pretty good bit, and positioning in the futures is no longer, super crowded on the short side. But we can dive into some of these individual charts. So like, for example, let's look at how positioning in gold has changed over the past few weeks. So this is like the commodities page. I'm scrolling down to the gold contract. Here it is. Okay, so as you know, gold trended lower, specs sort of jumped on the short bandwagon. We sort of got positioning got truly extreme for the first time in August, and that's where they were more net short than they'd ever been over the past 5 years. Then it popped up a bit, and positioning, a lot of the short positioning came out of the contract, but then they sort of got right back into it, and that's where we are now. Is positioning, it's not as extreme as it was a couple months ago, but it's still very safe to say that long gold is a contrarian trade. And then we can also dive into crude oil and see how that's changed. Let's see. So crude's positioning is still going lower, meaning that longs are being reduced and probably some shorts are being added onto it. But positioning, it's certainly not, crowded on the short side. So there's still about, and I've got the chart, I'll pull up in a second, but I think there's still 22 billion on the long side in WTI. And so, despite the drop, there's still significant long exposure in WTI, and it's definitely not crowded on the short side or anything. We can also zoom into natural gas. So let's see, natural gas. All right. So yeah, traders are very long, and that's what you'd expect after such, violent price action. But what's sort of interesting to me is that trader positioning, while it is long, it's not as long as it's been. So for example, in early 2017 and then in like May 2017, traders were more net long Henry Hub nat gas futures, like as a percentage relative to the past 5 years, than they are now. So all this to say is that current nat gas positioning is it's not like it's heads and shoulders more crowded on the long side than it has been in the recent past, which is sort of interesting to me given the magnitude of the move. It's certainly been a much bigger move than what sort of like, catalyzed this sort of positioning in late 2016, early 2017. Then we can look into some of the currency contracts. So like I talked about, we had yen, which was the most crowded FX trade on the short side. And it's sort of interesting to me in the sense that, the past month in financial markets or month and a half have decidedly been really risk off. But yen really hasn't, rallied that much. And then traders are very much in the short trade. And so if you were to see a further continuation of, risk assets fall, long yen is a trade that could potentially be explosive simply because everybody's not positioned for it. Then we can zoom into sort of like what that looks like in reality of this is what happened in the New Zealand dollar. So, Kiwi dollar was trending down. So in fact, we started from pretty stretched long spec positioning, and it was a yo-yo to the other side. This doesn't always happen. But yeah, so short Kiwi dollar got crowded. It stayed a crowded trade for a while. And then sure enough, it popped, whatever. I think it was like 3.5%, very quickly. And so that's an example of how a crowded short FX position can resolve itself is, short, quick, like 3% pop. Swiss franc is also, traders are quite pessimistic on the franc. And one of the more interesting CoT stats to me, I always look back, is right before the Swiss National Bank came in and basically, what was it? They removed the peg with the euro or something like that. Basically, before that monster move that wiped out a lot of people, spec positioning could not have been any worse. Going into that, traders were more net short, Swiss franc against the USD than they had almost ever been over the past 5 years. And so that is an extreme example of how price action can hurt crowded positioning. And then when it comes to other currencies, we got euro right here. Nothing to say about the euro. Euro positioning, spec positioning in euro futures is very sort of like, middle of the range. And so earlier this year, it was a very crowded long trade, like right here. You can see in April, traders were very long euro against the dollar, and it sort of fell apart in their face. That's not the case now, and that position is a lot more muted. We can also turn to index futures. So Dow, middle of the road. NASDAQ, still confusingly very low, meaning that traders are really not that bullish at all on NASDAQ futures, which is, maybe you'd expect that after the recent price action, but like even before it, spec positioning was like confusingly low in NASDAQ futures. And so this has been strange to me for a long period of time. But probably the most important contract is the E-mini S&P just because there's more money in it. So positioning has come off, the highs of the year. We're sort of in the middle of the range. It's a little interesting to me that spec positioning hasn't gone lower. There's still, what's the dollar figure? I think there's still around 52 billion in net long E-mini S&P spec exposure. And so what's interesting about that to me is that isn't a large number relative to the highs we saw in 2018. Like I think that's topped out at like net long, like 120 billion, which was a multi-decade high in net long S&P futures positioning specs. And so the current position of like net long 52 billion, it's a fraction of that, which is great. But if you zoom back like before January 2018, net long 52 billion is a really big figure. And so, yeah, if somebody says, oh, sentiment's decidedly one way in stocks right now, everybody sort of, pull their long exposure, they're bearish. I would say that futures positioning definitely points to that not being the case. There's still lots of long exposure in the S&P. And then we can turn to VIX. So VIX has gotten a little more interesting in the sense that, so traders actually, I know you can't discern it from this chart, but traders actually net long VIX futures, and they're net long not a massive amount of size like they were in April of this year, which ended up being like this big fade of like long volatility was a very bad trade to have on in April. So we're not. I think at that point in time, traders got net long like 1.5 billion. Now they're net long like 300 million. But either way, throughout this entire bull cycle, every time traders have gotten net long VIX futures, it's always been a fade. Now, obviously, if a recession were to materialize, I would assume that that would be the worst tell. I would bet VIX positioning would stay net long for an extended amount of time. But yeah, I just think it's useful to point out that traders, it's rare to see a net long VIX futures, and they definitely are right now. So we can turn to some other stuff. So that was COT, that's positioning. We can turn to seasonality, and seasonality is just the historical tendency of contracts to move up or down in given months of the year. So being late November, let's look ahead to December. So what contracts have historically performed the best in December? So on the left-hand side, we've got the highest 20-year average monthly performance. On the right-hand side, the worst. So the best performers in December, they sort of stand out, have been palladium and cotton. And the rest sort of less so. We've got sugar, corn, the S&P, euro. On the right-hand side, we really haven't had a lot of weak contracts in December, but OJ does stand out as being, having really poor performance in December. We can look at term structure. So this is just looking at the percent price difference between the front month and the second month. Basically, if it's positive, you got a contract in backwardation. If it's negative, contango. Backwardation, all else equal, good for longs. Contango, all else equal, bad for longs, because you're constantly having to sort of pay a roll yield to maintain your long exposure. So most of these contracts are in a mild form of contango. Corn, coffee, lumber. Contango is pretty steep, meaning it's pretty costly to maintain long exposure. And the big standout is nat gas. Obviously, that the market's very crazy right now. So nat gas is in backwardation, but that market's in a state of where the moves of like one day could wipe out any sort of roll yield over a month. So that's I would sort of downplay that. We can look at momentum in commodity futures. So I'll look at 12-month momentum because that's sort of a proxy for CTA sentiment. So CTAs more often than not trend followers, some short, some long. For those that are long-term trend followers, 12-month momentum is a good proxy for sort of their bias to a contract. And so the best performing contracts over the past 12 months have been natural gas, wheat, and palladium. And the worst performing have been orange juice, lumber, and I think that's soybean oil. We can zoom in on some of the individual seasonality. So for example, let's look at Palladium Seasonality. That was one of the best performers in December. Here you go. So this shows you the 5, 10, and 20-year sort of like average, yearly path of the contract. And this just shows you the 20-year average monthly performance. And so you can see it's the same number. December stands out. And yeah, it's actually been persistent. A little less so on the 5-year, but on 10 and 20-year lookbacks, December's been a strong month for palladium. We can also look at gold seasonality. And there's not much of it for December. So I wouldn't really read into any sort of gold seasonality stats for the rest of the year. But that being said, Q1 is a really strong period historically for precious metals. So you can see right here. In fact, it materializes here. January, February, gold ripped. Historically, that's been the trend. And it's not just gold. It's been industrial metals like copper. It's been platinum, even more so. Platinum is definitely more of an industrial metal than gold, and it's had pronounced outperformance in January and February. And so going into the new year, I would be cognizant of metal seasonality in January and February. We can also look at let's look at seasonality for financials. So 30-year bond, nothing. Pretty much the dominant seasonality trend in the 30-year bond is a strong summer, which really didn't pan out this year. Bonds have just struggled all year. and momentum is deeply negative for the 30-year bond. Means that, the trend is down. Euro's got a little bit of positive seasonality in December. In fact, that's the best performing month of the year for the euro. But I will say, I personally don't read a lot into FX seasonality. To me, there's just not that fundamental link of why there should be any seasonal trends. But the data does show that December has been quite a strong month for the euro. Momentum's negative, meaning long-term trend followers are probably leaning bearish on the euro. And historically, that's been a quite negative sign for the euro. As you can see, like when momentum, went negative here, those were historically very bad times to put on long euro exposure. Yen seasonality, November's actually been the worst month of the year for over the past 20 years. Not really, happening this month. S&P seasonality is pretty simple. Some people call it the best 6 months of the year. And they typically start November 1 and they last until end of April. You can sort of see it in this chart of where actually October's been really strong over the past 20 years. And so the sort of October to April period has been a much stronger period than the May to September period. But I will be the first to say that seasonality takes a massive backseat to, technicals or fundamentals like the earnings picture. And so that would be more paramount in my mind than S&P seasonality. Turning to momentum, though, here's what could get interesting. So there's a lot of people who run tactical equity strategies based on longer-term trend measures, be it 12-month momentum, a 10-month moving average, something like that, right? What I'm getting at is that if the S&P either stays where it is or goes even a little bit lower, it's going to be the first time momentum has been negative, 12-month momentum has been negative in the S&P since like early 2016. And now that was obviously a false signal, just like 2011, in that those were quote unquote, mild 15% corrections that didn't materialize into a big drawdown. But all that to say is, if this indicator flips negative, you're going to see a lot of like systematic money flip out of long S&P. And then speaking of S&P, last site we can turn to, it's called Simple Stock Model. All it does is just aggregate together a bunch of different S&P indicators in one place. So it's got 4 different pages: technical, sentiment, rates, and macro. So in technicals, this is actually the exact same momentum metric from this page right here. It's still positive. Another way you can assess the trend is relative to a moving average. So this is to the 200-day moving average. This is actually negative. So yeah, basically when you've got a shorter trend look back, you're more likely going to be below it given weakness. And so the S&P is, definitely below its 200-day. Here's another seasonality thing: best 6 months of the year. We're currently inside of them. The blue line. The blue line is, just have long exposure in those 6 months. The orange line is be long only the other 6 months. And you can see sort of the pronounced outperformance of that 6 month period. FOMC drift. So it's sort of weird, but basically the S&P has this tendency to outperform in the week or two leading up. It's like an FOMC announcement, and we're in that sort of that less than 20-day trading window is how I define it. And so that's historically matched buy and hold with a fraction of market exposure, like 80% or so. We can look at buybacks. So right now we are outside of the blackout period. So meaning that most of these companies have reported, they have started actively buying back their stock, which, as the blue line shows, those periods have done better than the blackout periods where companies have sort of been prohibited from buying back stock. Here's an interesting indicator: margin debt. So this graph actually doesn't show it, but based on like the super recent margin debt data, margin debt's quickly contracting. I think it dropped by like 40 billion from something like 550 billion to like 510 billion with the most recent reading. And so what that is meaning is that investors are deleveraging. So like, margin balances are decreasing. And that might sound like a good thing, right? So people, trot around that scary chart of margin debt so big, it's so scary, right? I don't interpret margin debt like that. The way I care about margin debt is 2 ways. I care if it rapidly accelerates. So think about it. If margin debt rapidly accelerates, that means people are quickly levering up, which means they're going to be more sensitive to a small drawdown if it were to materialize. That is bad in my mind. And then also what's bad is a period of like protracted margin debt, reduction being reduced. And so that means sort of people are in a mindset of reducing leverage. And if it happens for a long period of time, that means money is coming out of stocks. And so this indicator is really close to going negative. So margin debt, historically, whenever it's contracted year over year, it's been a pretty bad time to have S&P exposure. You can see the blue line is only being long the S&P if margin debt is positive year over year, if it's grown over the past year. And that's historically outperformed just, a buy and hold. So definitely keep an eye on margin debt if it continues to contract. I view that as a negative sign for the S&P. We can look at sentiment. So this is the AAA survey. It's like a retail-centric survey. Yeah, people have gotten more bearish. So like there's slightly less bulls than bears right now. But I definitely wouldn't interpret this survey as being super pessimistic. It's definitely not that. We got named. So this is sort of like a more institutional survey of like, hey, you like long S&P or not? Those people have definitely gotten more bearish. We got put call ratios. They're high. They're not extreme in my mind. And so it doesn't indicate massive panic like it did in September 2015. We've got the VIX curve. So this is as of last Friday. Obviously, based on yesterday's move, it flattened out a bit. We can look at rates. So yield curve. The Treasury yield curve between the 10 and 2 year, it's flattened by 35 bips over the past year. And what's historically, so a lot of people talk about the yield curve in the S&P, right? They talk about, oh dear God, when it inverts, that's the time to pull equity exposure. The big issue with that framework is the timetable can be either short or long, as in the yield curve is historically inverted as short as, 6 months before a recession. Sometimes it's taken 2-3 years. So to me, that has very little like knowledge in it. What's mattered a lot more about the yield curve with stocks is it rapidly flattening or steepening? And while rapidly flattening typically gets the negative connotation as being bad for stocks, historically, that's not the case. What's been worse for stocks is when the yield curve rapidly steepens, meaning either, short term is quickly dropping or long term is quickly rising or a combo of both. So you got to ask yourself, okay, when a yield curve quickly steepens, what's happening? More often than not, it's because we're entering a recession and the Fed is rapidly lowering short-term interest rates, which is what happened here and here. And then obviously here, which was not a recession, was a false positive. All this to say is yield curve has flattened 35 bips over the past 12 months. It has not steepened rapidly like these two times. High yield spreads. High yield spreads are worrying. They're expanding. They are greater than their 12-month moving average. It means they're widening out. And all else equal, that's bad. It's bad in the term of this. So like when both high yield and investment grade spreads blow out, what that means in plain English is that if you're a company and you want to issue more debt, you got to pay up, right? So that's going to make it harder for companies to sort of finance activity. We got TED spread. So all TED spread is the difference between a risky rate and a risk-free rate. This is 3-month LIBOR to 3-month treasuries. And that was a huge tell in the financial crisis of, stress in the banking system is when, LIBOR was really high and then Fed funds was, not Fed funds, but 3-month treasuries were a lot lower. TED spread, it hasn't done anything recently, so it's nothing to read into there. Last page I'll cover is macro indicators. So let's look at what's happening for the U.S. macro picture. Industrial production is healthy. It's expanded by 4% over the past year, although I'll be the first to say that just as industrial production sort of got depressed in 2015, 2016, this is an oil story here, right? It was pretty close to a recession in terms of, economic activity did slow down, but it was sort of isolated to a couple sectors. What I'm getting at is oil's fallen a lot, right? Industrial production is more of a manufacturing-centric indicator, and I'm fully expecting this indicator to fall, to reflect sort of the fall in the price of oil. Historically, it's been a very good tell of when to pull equity exposure. Retail sales. So if industrial production is looking at manufacturing, retail sales is sort of looking at the flip side of, okay, what about the consumer? Are they spending money or not? And they are. Real retail sales have increased by 2% over the past year. So it says that the American consumer is spending more money relative to the past year, which is a healthy sign for the economy. Unemployment rate, it's low and trending lower. It's 3.7%. you don't want to see this blowout. So if you've got an unemployment rate that's like rising greater than its 12-month moving average or whatever indicator, all that means that the labor market is getting weaker. And so that's a bad thing for the economy when people are, out of work. We're not there yet, but if it were to turn up, that'd be a bad sign. PMIs are high but falling lower, not just in the US, but international. Housing prices they're decelerating a little bit. I know people have talked about the housing story of, inventories are rising, mortgage rates are going up, housing demand is dampening, which is very true. That's the weakest part in my mind of the US macro picture is housing. And yeah, higher mortgage rates are definitely not helping that. And then EPS, S&P earnings per share are definitely up over the past year. This looks weird because of the weird 2009 print. But anyways, and that's sort of the conclusion for this website. I just roll everything together into one page. It gets a 1 if it's sort of above its threshold, 0 if it's not. And this composite model sort of looks at everything. It says, hey, healthy or not. And now I will say this is not, talking about like the intraday stuff that Larry does. This is more so sort of a longer term picture of the S&P, but technicals are getting worse, but still not super bad. Sentiment to me is not super extreme on the pessimistic side, which is what you want to see if you want to be long S&P. Rate picture is fine. High yield spreads are a little worrying though, and the macro picture is still strong, although it's getting worse. Anyways, that is a summary of everything. So we had positioning, we had some seasonality stuff, and then we had some S&P. So if anybody's got any questions, I'm happy to answer them.
Yes, thanks a lot. A lot of really good information. A lot of interesting points there. We actually do have 2 subscriber questions. One is, hang on, let me just.
Yeah.
You mentioned the VIX. When you brought up the VIX, you mentioned a comment that it's suspicious when it's long, or it's not typical. Could you go more into that? Why it's not typical that when the VIX actually is long, spec long?
Yeah. So that's actually, I haven't really thought about it this way, but most of these contracts, speculators, they're like baseline position is net long in all these commodities and all these financial futures. VIX is different just because the reason why there's a bias to be short is because more often than not, there's carry to be earned from a short volatility position. Now, we all know the payoff profile of a short vol position is, nickel, 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 and then blow up if you don't manage your risk. But just as, if a commodity is in contango, there's a premium to be earned by being short because there's this bleed down in the roll yield. The same thing exists in VIX futures, but you got to understand. Okay, so like literally, I'll show you the site I use for VIX is right here. So here's a quick view of the VIX term structure, and so it's first off, it's very weird right now. Like it's mostly flat, and then just because this December contract's gonna expire soon, there's sort of some pronounced contango here. Okay, so here's a quick crash course into how people actually make money, with the VIX curve. So people talk about the roll as making you money or losing you money. That's not really how it happens. Think about this. So right now, the big 2 VIX ETFs, you've got VXX, which is long vol, and SVXY, which is short vol. Okay, so if you're VXX, and both of them target a 30-day target maturity in VIX futures. So basically right now it's a blend of December and January futures. Okay, so let's say today it owns half and half. It owns half December, half January. And then let's say tomorrow VIX futures don't change in price. Let's say the price was the exact same. And let's say it rebalances its portfolio from selling a little bit of December, buying a little bit of January. That doesn't create any sort of profit. You're literally just sort of like allocating to a different security. So what I'm trying to impress upon, I guess, like listeners, is that the act of rolling your position doesn't make you your money. Here's why people make money short volatility. It's because more often than not, the VIX futures curve prices in implied volatility that's higher than what actually gets realized. So for example, like right here, Jan VIX futures are 19. Okay, so if when this futures contract expires, let's say VIX is 15, what that will have meant is that, VIX futures sort of priced out more volatility than actually happened. And so as VIX futures converge to maturity, they get closer and closer to spot VIX. And if spot VIX ends up being lower, than what people imply with VIX futures, then people lose money. And that was a more complicated way to say this. People are basically more freaked out about the future than the future actually ends up being volatile. And that's called the volatility risk premium. And it's not just in equities, it's also in other asset classes like commodities and bonds. And so tying back to the question of that's why people have a bias to be short VIX futures is because historically, not just this bull market cycle, but over decades, there's been this premium to earn from being short VIX futures. And that's why it's very strange to see traders be, where's my, it's back. It's strange to see traders net long because it's sort of the opposite of like, if there's this risk premium to earn from being short and you're long, you're sort of paying the premium, right? Anyways, though, yeah, so like if we look back over the past, I don't know how many years it says, but you can sort of see, now I know this chart, it doesn't show you if it's actually net long or net short, but trust me, if it's high up here, they're net long. It's just really rare. And like I talked about, this cycle, it's always paid to short vol after a spike. If this current correction ends up being, the one, sort of like the big market turn, I can assure you that the people who are quick to jump on short vol, they're gonna lose because the market will end up being more volatile than people expect. But if it's a repeat of early spring, then I don't know, expect VIX to come back down. So I hope that sort of answered stuff about the VIX market.
Yeah, no, that's really interesting actually. What about the euro specifically? Euro's basically approaching the low of the year. You kind of pointed out that we're clearly off the highs, but I would have expected the market to be a bit more short euros just because all the pops have been limited. It's a huge market, but it seems like pretty middle of the road.
Yeah, no, it is. It's there's nothing really to read into your position, I wouldn't think, but you got to think about it like this too. So this is a 5-year percentile. It's influenced by positioning in the past 5 years. Okay, so traders were mega net long here. They were also really net short in like mid 2015, right? And so those are sort of two like extreme focal points. And when you've got two extremes, basically anything else in the middle is going to look like a wash. And so let's actually, I'll just pull up the actual current report. And I'm curious to see the magnitude of short positioning. So let's see, scrolling down to financial, I'm searching for euro. Here we go. Okay. So this is the contract right here. So we got the different categories. We got asset managers, leverage funds, other reportables, and non-reportables. So, all right, so let's look at the position. So we got longs, shorts. Asset managers, think of it as like slower money. They're long 300,000 contracts, they're short 150. So there's a big net long 150,000 position there. Leverage funds, different story. Okay, so they're long 30,000 contracts, but they're short 130,000. So leverage funds are net short, what is that, 100,000 contracts. Other reportables, that's a wash, equal longs and shorts. Non-reportables, slightly net long. All this to say, so this is sort of interesting now that we've dived into it. There's nuance to the euro positioning right now. Slower money still has this big embedded net long exposure that they've gradually been reducing, right? Less longs, more short exposure. Leverage funds, different story. They've been very quick to jump on the short euro trade, and this is a that's a pretty big position right there, net short 100,000 contracts. So anyways, that shows you how you can sort of decompose spec positioning into the different categories, and the quote unquote fast money, like, fund traders, they're really short euro. And so, yeah, that's sort of interesting to look at.
Yeah. All right. Well, thanks a lot. That was a lot of really good information, and it's very interesting times right now. The crude you brought up before, it's short, but not, it
Well,
almost
no,
just
in
goes to
fact,
the fact.
it's not short. It's in fact, while I'm on the CFTC website, let's go ahead and look.
Right. Well, that's
At,
it's just one of those more. I guess though, for a commodity like that, it's difficult to be a net short. Isn't that right?
correct.
Or,
Correct. No, absolutely. Because think about it. Okay, look, and I know we've gone long, but I enjoy talking about this stuff. So think about this. Okay, in the crude market, the reason these commodity futures exist is for basically the people in the business to offset the price risk. And producers are the bigger player relative to users. So if you drill for crude oil, how you engage with futures is you sell them to lock in your future production. So if you got producers constantly selling, who takes the other side of that? More often than not, speculators, right? They're accepting the risk from the producers. So all these commodity markets, specs are always biased to the long side. And so like let's actually look at the spec positioning in crude. So here it is. So there's a ton of energy contracts. This is specifically WTI on the NYMEX. So let's look. Money managers. We got long 238,000 contracts, short 87,000 contracts. And then we've got other reportables, long 296,000 contracts, short 36,000 contracts. This should impress upon you that there is still a lot of net long exposure in WTI, like a lot. And so, yeah, it's even despite the correction. I don't know. There's no reason. So we're definitely not net short at all. We're still quite net long in WTI.
yeah. Interesting. Well, fascinating times. Definitely look forward to kind of keeping track of all this stuff, especially heading into year end. But Adam Collins, he's got some great sites: Movement Capital, freecotdata.com, movementcapital.com, simplestockmodels.com, and commodityseasonality.com. Thanks a lot,
Yep.
Adam. We'll talk to you soon.
Yeah. Talk to you later.